Hey guys, so I'm going to give you an update of what happened this last week, mainly around Jackson Hole. We'll talk a little bit about Cracker Barrel, and we'll talk about the new outlook for the economy. So with that, let's jump in. As always, this is not financial advice. Jackson Hole. Jerome Powell spoke at the Jackson Hole Symposium on Friday, and this had a pretty big impact on rates. Not only rates, but just the market. There was a big pivot, if you will, from holding higher for longer to opening the door for rate cuts. He highlighted that job growth it has a potential impact for decreasing. He noted that there was a 35,000 job add over the last 3 months, significantly down from the 3-month average before. We've been talking about weakening economy and downward revisions. He highlighted it in the symposium on Friday. So this probably leaves the door open to a rate cut. Now, people before were actually not expecting a rate cut, or they had actually reduced their odds of a rate cut quite a bit, and then right after the speech, they put it back in. So we'll get into that here in a second. Market reaction was very positive on Friday. The S&P was up like 1.67%. Dow went up as well, so very positive for the market, and rates fell. Okay, so look at this. Right before the talk, which was 9 o'clock Central Time, market was pricing in a 75% chance of a rate cut, or 25% that it wouldn't cut at all. And a couple weeks before, it was 90%. So they had given back some of the odds of a rate cut. Right after the meeting, right after the transcript was released, look at that, 91% chance of a rate cut. So this definitely signaled a pivot on rates, which is a good thing. This is going to be a great thing for the economy. Now, the challenge is going to be is that hopefully it's not too late. Remember, there are long and variable lags with rates. So just because you cut today doesn't mean it's going to be felt by the economy today. It takes 12 to 18 months for that rate cut to be realized in the economy. So if they didn't hold it here too long, and there isn't already a tipping point with unemployment, that it could be a soft landing. Now, remember the jobs from January and February where the government laid off 400,000. We don't know whether they found jobs or not. If they haven't found jobs, even if half haven't found jobs, I think 200,000 people are not included in the unemployment report. So September and October is going to be a pretty interesting watch. All right, so yeah, 25 or 90% chance of a rate cut now. And here, looking at July next year, they only had 4 cuts priced in. Now we've got 5. Let's look at rates. The 2-year, you guys know I'm long on the 2-year. I'm long on the overnight rate. So this was going back to August when we had the unemployment report on August 1st that showed there were significant downward revisions and a rise in unemployment. That's going to cause rates to fall, especially on the short end. And then it kind of gave it back. Throughout the month, it was like, I don't know if it's so bad. It kind of gave almost half of it back. And then look, the speech came out, and it was around 381 for the 2-year. And, now it's 369, 370, something like that. So it dropped about 12 basis points. Now looking at the 10-year. So the 2-year, think short rates. Think of like auto loans, things like that. The 10-year, think mortgages. Mortgage rates are benchmarked to the 10-year. So whatever the 10-year rate is, add another 2% to 3%. That's what mortgage rates are going to be. So they were around 433 on Friday morning. And then afterwards, they gave up about 8 basis points, fell 8 basis points. So think of that's a good thing. Fell 8 basis points. But if you notice, it didn't fall as much as the 2-year. So that's called a bull steepener. So you have the long end of the curve. They're both coming down, but not as much. So the 2-year is going to fall faster than the 10-year. That's called a bull steepener in rates. And this has impact on different sectors of the stock market. So with that, I'm going to jump into that. All right, so here is something I put together that shows the impact of a bull steepener. This is the short end falling, long end rising. It also is correlated with just a rate cutting cycle. This is good for the economy because this will spur economic growth as long as we don't have an exogenous event or unemployment rise a lot. Because if unemployment rises a lot, you're going to see the stock market fall. If it stays where it's at and it's a gradual thing, then it should be a positive. But barring an exogenous event and barring any significant change in employment, this is what you can expect. Financials. So these are sector spiders. Let me go into that first. Sector spiders are, there's 11 of them, and you take all the S&P 500 stocks, which is 503, and you divide them up into these categories. So there's financials, there's discretion, there's technology, and so on and so forth. So financials is going to be positively impacted strongly because a bull steepener is banks borrow on the short end and they loan out on the long end. So when that long end stays higher, think mortgages, it'll be higher, so more income over there, but they're borrowing on the certificates and demand deposits and savings accounts. So that's going to be a lot lower. This stays up. This is very, very positive for the financial sector. Consumer discretionary, positive as well. Think of automobile purchases, homes, appliances, borrowing on the lower end of the curve. This is a positive for discretionary. Industrials, materials, think capital cost and borrowing. So this is going to be tied to the 10-year. But if rates do come down as a bull steepener, so you're going to have rates still coming down, not as much, but still coming down on that long end, this is going to be positive because borrowing costs for these companies are going to be lower because everything's based on the 10-year. We looked at that a second ago. Technology is going to be good. Real estate, this could be good for like mortgage REITs. If you take a look at one of my favorite stocks is AGNC. They did very well on Friday and will probably continue to do well. This is very good for the real estate. Think mortgages. If mortgages do come down even just a little bit, there's a lot of pent-up demand. The housing market has done very well. DHI, Lennar, all those guys have performed very well because everybody's feeling like, hey, finally we're coming into a rate cutting cycle. That is going to shift my belief here in the next few months. All right, so communication services, utilities. Utilities is kind of like a bond proxy. Utilities pay high dividends, so people will put, for income-focused investors, they'll buy utility stocks because they pay a good dividend. As rates fall, then the dividend's going to fall and it's going to lose its appeal, and then people go risk on looking for income somewhere else. And then staples, healthcare is going to be potentially a negative effect because staples are a defensive sector and people will go where they think they can make more. And then energy, positive. I've written this report. It's about a 5-page report. If you guys want it, let me know. Put a note down in the comments. I'll give you, I'll be glad to send this to you. It's got some different things and a little bit more on the whys of how the bull steepener helps the different sectors. All right, so now looking at the big picture, the S&P. I've been talking about how I've been shorting the market. So look, this last week it fell. Nothing drastic, but it did fall. So that was positive for my position. I went ahead and rolled down. I rolled down actually on Thursday because I didn't know what this event was going to do. And I rolled down, meaning I had a position that was very profitable. I rolled it down, took some of my profit off so that if the market went the other direction, then I wouldn't lose as much. And I had a hedge also on that side. I did close out my hedge on that side because that was profitable as well. I took it off and I'm going to watch it very, very closely over the next couple of days because if the market continues to rise, then my overall position will be down. But given that we're in a seasonal negative time of the year, I decided I know that the rate outlook is positive, but we are in a seasonal pattern. So I decided to hold my short position for now. And I'm being very, very tactical, and it's something I'm going to watch very, very closely. So we're at a near all-time high again, and this line here represents the 25-year average of the market. You can see that going into September it falls, and then you get about October. October can be very volatile, but right after October, even mid-October, you'll see where it starts coming back. So that is where I'm going to be changing my strategy. I will be bearish probably throughout the end of August and into September, very tactically bearish. But then with this rate cutting cycle, and depending on the new reports that will be coming out, because we get another unemployment report, we'll get CPI, PCE this week, I will be very cautious on how I set up my strategy. But you can see here that it bounced off the 20-day, shot right up. Here's the 50-day, here's the 200-day. So we're very bullish. and we're in a long bullish uptrend. But you do have some divergences with relative strength. You've got new higher highs, but lower highs on relative strength. This is just technical analysis. Whether it follows it or not, who knows? Take it with a grain of salt, but that's what's coming up. So let's talk about Cracker Barrel. So this was interesting. This is the new logo. If you guys haven't heard about this already, it's all over social media. I'll be surprised if you hadn't. There's the new logo. There's the old logo. This is my take on it. I think they made a bad choice here. This logo is awful looking. And the people who go here associate with this right here. It's very down home, country feel. You've got this older guy leaning up against the barrel, kind of a grandpa, country folk person. And I don't know if this is a woke trend or what, but these are probably some of the most anti-woke people in the U.S. And you go to something like this, I don't know if they were trying to get rid of the old guy or what, but not a good move. They lost $100 million in equity value because of this stunt, or move, I should say. Now, they can either suck it up and move on and continue on with this and, come out and do their best. They could go back. I don't know that they'll go back. They'll probably stick with this, but they need to realize that why didn't they do a test? Why didn't they just test it and see how it worked with some of their most loyal people? Just test the design and see if it worked. Maybe in a couple locations. I don't know. Doesn't make sense to me, but I did look at their financials. I thought, well, how big of a deal is this? Here's that loss that they had. They went from $72 a share down to $54. How much further down will they go? Who knows? But they were down to 36 back in April. So I would guess that they still have further downside. I was thinking, well, do I sell puts on this? I'm staying away. Look at the 5-year. They were at $178. So they did bring in the new CEO to do something. And she's changing marketing. I don't know if that's the place I would have started. I do like the design on the inside. They went to a more fresh look, less cluttered. I do like that. I just don't like the logo. I think it's terrible. And it doesn't speak to the audience at all. So, looking at their financials, yeah, not so good here. I think they have further downside to go. If I look at their PE ratio, which is their price to how much they make, their earnings, I think it's a little high. Given that, I think then the share price still has room to fall. Look at Darden. Think of your Olive Gardens, Chewy's, Ruth's Chris, Bahama Ice. There's several different companies in here. And these guys are doing well. I mean, they're at 23. So I think, would I compare Cracker Barrel with some of those brands? Probably not. Look at Denny's. They're at 14.5. I would probably, if it were me, I would probably put Cracker Barrel along kind of like it with a Denny's type brand, which to me, Cracker Barrel, then if that's the case, Cracker Barrel is overvalued from their price to earnings. So I will be staying away from it because I think they have more room to go. All right, so looking at the next week, we've got some simple things. I think rates are going to be probably pretty benign. I don't see any big shift in rates. The market, who knows? When the market opens tonight, futures market, I'll be watching it. Right now, if you look at cryptos, it's Sunday afternoon when I'm doing this, but if you look at cryptos, they're down. So I would expect the sentiment to also apply to futures. Tomorrow, it may open up, may open down. I don't know. I'll be tactically watching it. And but you've got a couple of things. Durable goods up on Tuesday. And then GDP, the second look. We had the advance a few weeks ago. That was the first look. Now we get the second look. On Thursday, I don't expect any major thing here. And then you've got PCE. PCE, we already had some insight with CPI. So if this comes in benign, but if anything's going to change rates, it will be that. So I will have my rate positions. I will be opening a 20-year straddle on the 20-year, giving it about a 20 basis point move either way. That I'll be profitable. I don't expect rates to move more than that. On the long end of the curve, I think that will stay still. The short end of the curve, I'm long, so I don't know if rates will continue to fall this week or not. PCE will determine that. And then we'll go from there. We'll see what happens. So I think it'll be kind of a quiet week. Watch the market. We'll see what that does. And if you like this, please let me know in the comments if you want a copy of that report. drop me a note in the comments as well, and I'll be glad to email it to you, or send me an email, and I'll send it to you. All right, with that, happy trading, and thank you very much.